Over the last year, BTC has more than tripled in price and has just hit a new all-time high. This rally has been driven primarily by the speculation around and the subsequent approval of spot Bitcoin ETFs, and it's left everyone wondering how high BTC will go and whether altcoins will follow. That's why today we're going to explain exactly what's been going on in the crypto market, including where we are in the crypto cycle, when altcoins will follow BTC, and why this time could be different.
This could be something completely different.
My name is Guy, and if you hold crypto or are considering it, then this is a video you need to watch. Understanding what's going on in the crypto market and where it's headed fundamentally involves understanding who is doing the buying and selling and why. For the purposes of this video, there are three kinds of crypto investors you need to know about: TradFi whales, crypto whales, and retail. Now, traditional finance, aka TradFi whales, are wealthy individuals and institutions who invest most of their money into traditional assets like stocks and bonds, hence the term TradFi. Although some TradFi whales have been investing in crypto for a long time, most of them were not able to invest until very recently. This is basically because there are regulations in place which prevent certain types of institutions from investing in risky assets such as crypto. These include banks, pension funds, and certain asset managers. While these regulations don't exist everywhere, they do in the United States, where most TradFi money is managed. As you might have guessed, these limitations were removed when the US Securities and Exchange Commission, or SEC, approved all the pending spot Bitcoin ETF applications. Now, for context, a spot ETF trades like a stock and is backed by the asset whose price it's designed to mirror. That means every time someone buys a share in a spot Bitcoin ETF, actual BTC is bought. Obviously, the practical effect of ETF buys is that BTC's price goes up, and the result is what I mentioned in the introduction: BTC's price essentially going up only since the ETF approvals in early January. Believe it or not, but BTC could continue to go up only indefinitely. And this is for three reasons. The first is that it takes time for TradFi whales to begin offering the spot Bitcoin ETFs to their clients. For example, Bank of America and Wells Fargo only began offering the spot Bitcoin ETFs to their clients last week. I'll quickly note here that it's the clients of these institutions who are buying, not the institutions themselves. Regardless, it's probably going to take a few months for most TradFi institutions in the United States to offer the spot Bitcoin ETFs to their clients. The consequence of this is that there will be a constant, growing stream of capital entering these ETFs for the foreseeable future. And of course, that will be positive for BTC. And this ties into the second reason why BTC could continue to go up only, and that's passive flows. Now, if you've been keeping up with our weekly crypto reviews, you'll know that most TradFi investing is done in a passive manner. Put simply, TradFi institutions will automatically buy assets as part of their allocations. As such, it's likely that some TradFi institutions will include the spot Bitcoin ETFs as part of their automated allocations now that they're available. Even though these allocations are likely to be small in percentage terms, in dollar terms, they could be enough to perpetually push up BTC's price. That's because of the third reason why BTC could continue to go up only, and that's the restrictions around its supply. According to Glassnode, only around 11% of BTC's supply is currently on exchanges. To all intents and purposes, that's the only tradable BTC available. The rest is being hodled in wallets. That stands for holding on for dear life, by the way. Now consider that the spot Bitcoin ETFs have gobbled up 1 million BTC in just 2 months. Even when you factor in the BTC being produced every day by Bitcoin miners, there is a chronic shortage of BTC that's available to buy. As basic economics dictate, less supply with the same or more demand equals moon, or something like that. In all seriousness, there's been speculation that the spot Bitcoin ETFs will soon run out of BTC to buy, and that BTC's price will go exponentially higher as a result. Now, this is certainly possible, but it's objectively unlikely for many reasons. For starters, the US government still holds around 200,000 BTC worth $14 billion. For reference, the US government recently sold around $1 billion worth of BTC, and it is likely that it will continue to sell if prices continue to rise. There also seem to be other sources of sell pressure in the short term, such as bankrupt crypto entities selling large amounts of BTC to repay creditors. Even so, there's a point at which all of this BTC will be sold. Once that happens, BTC's price could literally go vertical. And by the way, if you're enjoying the video so far, be sure to smash that like button to give it a boost, and subscribe to the channel and ping that notification bell so you don't miss the next one. Now, you'd be forgiven for thinking that the crypto story ends with these TradFi investors. However, everyone seems to forget that there are other potentially larger forces at play within the crypto market. Crypto whales are the elephants in the room in this regard, and they've been playing a peculiar role recently. Like TradFi whales, crypto whales spend most of their time pumping and dumping on irrational retail investors for a massive profit. What's funny is that some crypto whales appear to have pumped and dumped on all the TradFi whales that have been rushing in to buy the spot Bitcoin ETFs. For those unaware, large crypto entities such as Binance and Tether have been propping up crypto prices for at least a year. In Binance's case, former CEO Changpeng Zhao announced last March that the exchange would, quote, convert billions of dollars of its BUSD stablecoin into other cryptocurrencies. Logically, this likely had the effect of supporting the prices of the cryptos that were purchased. There's also on-chain evidence which suggests that Binance could have done the same with some of its USDC holdings. It appears that Binance's USDC holdings declined significantly shortly after the BUSD conversion. Whatever the case with Binance, it's also clear that Tether has been playing a role in propping up the crypto market too. This is because the stablecoin issuer explicitly stated that it would be using a portion of the profits on its USDT reserves to buy BTC every month last May. Now, the exact amount that's been bought has not been disclosed. Still, it's likely that Tether's BTC purchases have amounted to hundreds of millions, if not billions of dollars, given that USDT currently has a supply of over 100 billion, and its reserves are earning as much as 5%. Quick maths tells you that's as much as $5 billion per year in basically passive income. Not too shabby. But that is just the pump part of the crypto whale equation. On the dump part, there was a, quote, brick wall of sell pressure on major exchanges at the 52K level, particularly on Bitfinex. FYI, Bitfinex is a crypto exchange that's popular with Bitcoin whales, and it also happens to be Tether's sister company. As you can see, this brick wall of selling pressure didn't stay up for too long. Eventually, the buying pressure from TradFi whales broke through this level. It appears that there was a similar brick wall around 64K, and at the time of shooting, BTC is retracing after briefly breaking above its previous high of just over 69K. So, this begs the question of how much BTC crypto whales have left to sell and when they will sell it. Well, the honest answer is nobody knows. For what it's worth, though, the order books on Binance suggest that there is a massive sell wall from 69K all the way up to 76K, which could be BTC's short-term price target. And that reminds me, you need to remember the role that leveraged trading plays in BTC's price action. As most of you will know, leverage trading effectively involves borrowing money to bet on whether an asset's price will go up or down. As a fun fact, most trading in crypto involves leverage. When traders bet that BTC's price will go down, but it goes up instead, This causes a short squeeze, which involves these BTC traders being forced to buy BTC with the assets they put up as margin, aka collateral, usually USDT. This causes more traders to get short squeezed, driving BTC's price higher, and so on. On the flip side, when traders bet that BTC's price will go up, but it instead goes down, this causes cascading liquidations, which involve these BTC traders being forced to sell BTC. This causes more traders to get liquidated, driving BTC's price lower, and so on. This is why BTC can be so volatile around key levels. What some of you may not know, however, is that there is a third factor to leverage trading that can trigger a short squeeze or a cascading liquidation. This factor is funding rates, which can be easily understood as the cost to hold a long or short position. As funding rates rise, leverage becomes more expensive, and this eventually causes some traders to close their positions at a loss against their will, which can in turn trigger a short squeeze or a liquidation, depending on whether the funding rate is expensive for shorts or longs, respectively. Funding rates are currently expensive for longs, which risks cascading liquidations. On that note, if you happen to be a current or aspiring crypto trader, then you need to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $50,000 on the best crypto exchanges. These deals are only available to Coin Bureau viewers and won't be around forever, so take advantage of them using the link in the description ASAP. Now, this relates to retail investors. Historically, crypto whales have used their BTC profits to buy altcoins so they can pump and dump on all the new retail investors flooding into the market, allegedly. This time around, however, there seems to be a lack of rotation, and this is for two reasons. The first is that the buying pressure from the spot Bitcoin ETFs could have taken the crypto whales by surprise, leaving them with profits they weren't expecting. The second is that retail investors haven't really started paying attention yet, at least not those who aren't already heavily involved in crypto. Now, the first reason could have crypto whales wondering if it might be more prudent to reinvest into BTC as opposed to altcoins and keep riding the waves caused by TradFi whales, especially when you factor in the second reason. Newsflash, but no new retail investors means that it's hard to pump and dump altcoins. This is why it's possible that the recent meme coin rally was orchestrated by crypto whales. By stimulating the most speculative part of the crypto market, it tempts more retail investors into the crypto waters. Remember that Robinhood made most of its crypto trading profits from Doge trading. So far, this seems to have been an effective strategy, and we're slowly starting to see retail-related metrics tick up. These include the popularity of crypto trading apps on app stores, the number of Google searches for meme coins, and even the number of views we're getting on this channel. Welcome, by the way, to all viewers joining us for the first time. Now, the question is whether the sparks of the meme coin rally will be enough to create an altcoin fire, or rather, will it be enough to bring in new retail speculation to the crypto market? The answer is complicated because retail investors don't seem to be in the best shape these days. The combination of high inflation and high interest rates has taken a toll on retail investors around the world. In the United States, for example, household debt and credit card debt are at record highs. This is significant considering that most of the retail capital flowing into crypto comes from the United States. Come to think of it, the recent meme coin craze could be due to the financial state that most retail investors are in. If you watched our video about how to analyze meme coins, you'll know that they're analogous to lottery tickets. Gambling-like behavior tends to increase when people are financially stretched. After all, what's the point of making a strategic investment when you only have a few $100s to invest? Better perhaps to just YOLO into some meme coin and hope it 100x's so you can pay back some of your debts. For many people, even a 2x on a few $100s would go a long way towards making ends meet. This fact is easily forgotten by the retail investors who are already heavily involved in crypto, most of whom are financially better off than retail tourists, statistically speaking. Per our summaries of related reports, veteran retail crypto investors tend to be young, educated, and upper-middle-class men. Anyway, statistics aside, the fact of the matter is that there has been a lack of rotation into altcoins, at least at first glance. Upon closer inspection, though, you realize that it's not so much that altcoins have been underperforming. Rather, it's BTC that's been outperforming due to the steady spot Bitcoin ETF inflows. As many analysts have pointed out, the capital going into the spot Bitcoin ETFs probably isn't going to find its way into altcoins. The caveat to that, though, is something I mentioned a few moments ago, and that's that crypto whales still exist. Put differently, you haven't taken anything away from the crypto market. All you've done is add an additional category of whales, which are, for the time being, directing their crypto-related capital to BTC. And this has probably left crypto whales in an awkward position, and it's possible that it's also tempting retail investors to just ride the TradFi waves with BTC instead of altcoins. This wouldn't be surprising given that the SEC has been actively going after many altcoins. It stands to reason that informed retail investors would steer clear of altcoins purely because they don't know which ones the SEC will go after next, a fact that's easily forgotten by less informed retail investors. Speaking of which, it's easy for everyone to forget that the regulations around crypto exchanges have changed significantly since the last bull market as well. It is no longer possible for investors in places like the US and UK to access the offshore crypto exchanges where the most speculative altcoins are traded. If you've been keeping up with our coverage of crypto regulations, you'll know there have also been moves to restrict DeFi access in these places. Some DeFi protocols have already blocked US users from interacting with their front ends, and many crypto projects have restricted them from airdrops as well. Thankfully, there are still promising altcoins out there, which is why we created the Coin Bureau Club. Every week, we do reviews of small-cap altcoins that our members voted for. Members also get to see our personal crypto portfolios and our watch lists. They even get daily crypto market updates and analysis. So, if you don't have the time to do all of this stuff yourself, save yourself the hassle and become a member of the Coin Bureau Club using the link in the description. This brings me to the most important part of the video, and that's all the ways that this crypto market cycle is different from the previous cycles. You'll notice I've just mentioned a few. TradFi whales blowing up BTC's price, crypto whales being caught off guard, and retail investors being apathetic or unavailable. The crazy thing is that this is just what's different on the crypto front. On the macro front, we've got interest rates at multi-decade highs around the world, the real inflation rate being much higher than what's being reported, and geopolitical conflicts emerging and escalating every other day. In theory, all of this should be bearish for the markets, including crypto. In practice, though, most major stock market indices have been hitting new all-time highs, including many cryptos. The catch is that most of these markets, including BTC, have not actually been hitting all-time highs in real terms. To put things into perspective, the US Federal Reserve alone increased the money supply by roughly 40% between 2020 and 2022. As almost everyone knows, this huge increase in the money supply was the biggest source of fuel for the previous market rally, thanks in large part to the direct stimulus to retail. What this means is that the actual inflation-adjusted prices of most assets, again including BTC, could be up to 40% lower than what we're all seeing on the screen. At the time of shooting this video, this would put BTC's inflation-adjusted price closer to 50k, which is where many traders believed the local top would be. If this is in fact the case, then BTC could see a sizable correction from its recent highs before the next rally. And this would be consistent with BTC's historical price action, where corrections occurred just before or just after the halving. In case you missed the memo, by the way, the halving is scheduled for sometime in April. If this scenario plays out, then the silver lining is that it will also apply to BTC's top target for this crypto market cycle. So, based on the diminishing returns BTC has seen over previous cycles, A historical analysis based on non-inflation adjusted prices gives you a BTC price of between 120 and 140k. But if you factor in the 40% inflation that's been caused by all the money printing during the pandemic, you end up with a BTC price of almost 200k at the cycle top. As with the recent rally to all-time highs, a rally to 200k would likely take most experienced crypto investors by surprise, be they whales or retail. Naturally, the same rule would apply to all the altcoins. They could all surprise to the upside. Some of them already have. At the end of the day, it's the disconnect between BTC's price action and historical cycles that has people thinking this time is different. This can be explained by plain old fiat inflation. In sum then, it's quite possible that the historical 4-year cycle is still intact. There's just one piece that doesn't fit into this puzzle, however, and that's the buying by new TradFi whales. Those dynamics are real regardless of the inflation-adjusted numbers. The thing is, though, that we've yet to see a proper correction. Let me remind you that since the start of the year, it's been up only in crypto and stocks. Well, not to burst anyone's bubble here, but nothing goes up only. Eventually, there's a correction. And it's safe to say that it's going to be fascinating to see how these TradFi investors react when BTC goes down for the first time in their experience. And it's going to be even more fascinating to see how BTC's price changes relative to the other assets out there. It's believed that most TradFi investors see BTC as a safe haven asset, but we have yet to see this fact stress tested. It is quite possible that most of them still see BTC as a risk asset, like tech stocks. In other words, it's possible that outflows from the spot Bitcoin ETFs will be just as big as the inflows when the broader markets turn bearish. Recall that buying spot Bitcoin ETFs results in actual BTC buys behind the scenes. Well, the same is true in reverse, and that's something we all need to remember. And that's all for today's video. So if you found it informative, smash that like button to let us know. If you want to stay informed, subscribe to the channel and ping that notification bell. If you want to help inform others about what's been going on in the crypto market, then be sure to share this video with them. And with all that said, thank you all so much for watching, and I'll see you in the next one.